You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello and welcome to The Investor Way with myself, John McEwen, my co-host Sam Ball. This week on The Investor Way, we have OnTheMarket, LVMH, Relx, Nestle, Whitbread, and our US company of the week is PepsiCo. Sam, do you want to kick us off with OnTheMarket?
Absolutely. So we've covered it a couple of years ago and weren't overly impressed with it. So it's basically a tiny little competitor to Rightmove. I think the main difference between it, other than the fact that it's got a tiny market share, is that it splits. Was it owned by agents? Or
I believe that's how it started,
agent backed. Yeah. So they, rather than the Rightmove, which absolutely rinses the agents, the agents actually get something back from it. So in theory, they're more invested in it, but that isn't reflected in the market share. So we've never really covered it again, just because Rightmove's got an 85% market share and it didn't really seem like OnTheMarket was getting any traction. However, in the last week or so, OnTheMarket have agreed a £99 million takeover deal with CoStar. So I'm just going to read this straight from an article, which is from mortgagestrategy.co.uk. Property portal OnTheMarket has agreed a £99 million cash takeover by US rival CoStar Group, giving the American firm a UK presence. Shareholders of the estate agent-backed hub will receive 110p a share, which is a 56% premium to the closing price on the 18th of October, the day before the announcement. AIM listed on the market, founded in 2013, competes with Rightmove and Zoopla in the house sales market. The UK portal posted a narrowing full-year pre-tax loss of $200,000 in July, down from $1.2 million a year ago, and sales lifted 14% to $34.4 million. Worth noting, these results are radically different from the profits that Rightmove churns out. But it was added that the estate agents cancelling contracts with the business were higher than expected. CoStar, founded in 1987, has a market value in New York of over $33 billion, and they've added that the move offers an attractive strategic entry point for CoStar into the UK residential property market. The US firm's website attracted around 280 million visits in September, including Homes.com, the second largest US residential marketplace. CoStar adds the acquisition will be an important step in the expansion of CoStar's Homes.com residential network, not only in the UK, but across Europe. CoStar founder and CEO Andy Florence says CoStar has a strong track record of acquiring, investing in and building online property marketplaces into leading positions, including LoopNet, Apartments.com, and most recently Homes.com. We are excited to combine CoStar's resources and leading marketplace experience with OnTheMarket's agent-focused culture to create a leading player in the UK marketplace and provide increased choice and higher quality offerings for consumers. OnTheMarket chairman Churs Bell adds the offer from CoStar recognises the quality of OnTheMarket and the significant potential of the business, while offering shareholders an attractive opportunity to realise their investment at a substantial premium to the prevailing share price. In terms of share price, obviously, it's now trading at 108p a share, which is basically the offer price. And that is up from, well, earlier this month, actually, it was trading around 65p a share, maybe towards 70p a share. So got a massive jump. Rightmove's share price has taken a hit as well. So Rightmove's down about 15% on the news, from about 590p a share, and it's down to about 480 now. So that is the news, really. So it's just what impact, if any, it's likely to have on Rightmove. My view is that Rightmove's so entrenched, and from a consumer point of view, is such a good service. It's where everything's listed. It's where people go to just by default. I don't think having a big US backer really changes anything for OnTheMarket. Rightmove's got about an 85% market share. I'm not saying Rightmove's as good a business as Coca-Cola, but it's kind of like if you gave me £1 billion of marketing money, you only need to look at Richard Branson's Virgin Coke. You could give me the biggest marketing budget in the world. I couldn't dislodge Coca-Cola in the cola industry. And I think no matter how much money you throw at it, I don't think people are going to go away from Rightmove, because from a consumer point of view, Rightmove offers everything. I understand why the agents don't like it, but the website isn't geared to the agents, it's geared to the consumers. So for me, and as a Rightmove shareholder, I genuinely view this. It'll be interesting to see how it develops, but I'm not concerned at all. I view it as a bit of a non-event. I don't think Rightmove is 15% less valuable because OnTheMarket is going to start throwing loads of money. I even if I wasn't a Rightmove shareholder, if I'm looking to rent or to buy, I will look on Rightmove because I know that's where all the properties are. And I don't think that's really going to change. I don't really think for anyone. I could be proven wrong. I might be sat here in 2 or 3 years' time talking about Rightmove saying, well, we should have sold. It's so obvious. But I just do not see it. So what do you think, John, as a fellow Rightmove shareholder?
I'd like to think the same thing. And on the balance of things, I probably do. But I think it is a concern because I suspect, and I haven't, downloaded whatever the CoStar app is, whether it's Homes.com, but I would imagine if it's the market leader in the US, it's probably very slick. So from a consumer point of view, if everything or more things were to move on to there, and they have a very slick app, slick website, and there is a lot of marketing, huge marketing spend, then I would worry that the effective monopoly that Rightmove has might begin to be impacted. And I don't know how much more you can innovate in terms of the app and the features of the website, but Rightmove has done that over the years, and whether with the backing of CoStar, OnTheMarket could begin to do it, probably not that likely, and perhaps that is why you've only seen 10% drop or so in the Rightmove share price. I mean, time will obviously tell, but Rightmove does have those huge margins, and if the market share or the more competition came into the market and got traction, it might not be in the position that it has enjoyed for the last 5 or 10 years. And I guess again with Rightmove, it is UK focused. It's not really aiming to expand overseas. So if that UK market was disrupted, it would be very bad for the group.
Yeah, I'm still not worried. Well, maybe this will be one in a couple of years where we'll come back and I'll just look like an idiot. But if you said to me, the OnTheMarket app's a little bit slicker now than Rightmove, I still wouldn't use it.
No. I mean, I take your point, and I probably overall agree with you, and I'm holding on to my Rightmove shares. So we will see, and it's interesting to follow, and particularly if you've got sort of skin in the game. It's sitting on the edge of a seat a little bit more.
It has brought the Rightmove share price down to about 20 times earnings now, so it's the cheapest it's been for a little bit. I don't think it's actually a bad time to top up because I don't think this really changes the business. But yeah, that's everything really. So should we move on to a higher quality business than OnTheMarket?
Yeah, so it's LVMH, Moet, Hennessy, Vuitton. It's one of the highest quality businesses in the world. It's up there with Coca-Cola. It's at the sort of luxury end of the market, obviously, with brands like that. It owns some of the world's most famous luxury brands. It has Moet Champagne, Louis Vuitton, Dior, Bulgari, and it's recently acquired Tiffany. It's really incredible in terms of, if you can think of a luxury brand, there's a good chance that it's in the portfolio, and they're just some of the most famous ones that it owns, but huge amounts. It's quite diversified in that, you've got things from champagne to perfume, leather goods, watches, jewelry. It's sort of got everything really. Anyway, they had a third quarter trading update out with organic revenue rising 14% to 62.2 billion euros in the first 9 months of the year. And that does mark a slowdown compared with the 17% growth seen in the first and second quarters. The biggest division, fashion and leather goods, saw revenue rise 16% to 13.9 billion euros, which reflected strong performance in the leading brands, including Louis Vuitton. All other business areas saw growth, apart from the wines and spirits, which struggled in some of those more competitive periods, and Hennessy demand moderated, partly because of the economic environment. Watches and jewelry was the slowest grower, while strong demand for the Sephora products meant that selective retailing revenue rose 26%. The group said that it had confidence in achieving growth, but acknowledged the uncertain economic conditions. The shares were down about 6% following the statement. In terms of valuation, the group has a market cap of 364 billion euros and trades at 21 times forward earnings, compared with a 10-year average of around 23, with a yield of 2%. in terms of the group's organic revenue slowing from 17% to 9% in the third quarter, it was largely down to the wine and spirits business, which had tough comparisons. And I think perhaps as well, it's not at the very highest end in that it's more your average consumer with some of their, top ends of discretionary spending, with fewer bottles of, high-end champagnes and Hennessy, rather than the really high margin and their biggest division, which is fashion leather goods, which is done very well. So I think there is, some of the macroeconomic conditions impacting on it, which when you're at the very high end, you don't expect quite as much. But I wouldn't be so worried about that division with those sales falling a bit, as long as you've got, the fashion and the leather goods and those items at the really higher price points still doing, well. And I think, not that I'm into my fashion, but Louis Vuitton is rated really highly in terms of the new products that it does come out with. It's not sort of faltering. It's not in, like Burberry at all. It's at the top end, and people do sort of rate that fashion house. So I think, and same with Dior too. So I think it's sort of got a lot of best-in-class labels there, and they're the ones that are sort of increasing their sales. So I thought overall the results were pretty reasonable in the market conditions. I think you have seen that valuation slip back a bit to reflect the macroeconomic environment that we're in. But I still really, really rate this company. The shares, shares are never going to be cheap. And actually, it's probably not a bad time if you were looking to start a position, given some of the negative news on it. I suppose the other thing is that the debt has gone up a bit with the acquisition of Tiffany, but it's sort of well under control and they're in a good position to pay that down. So that wouldn't be so much of a concern. But no, I really like the company, and it's been on my watch list for a while and remains so. I don't know whether I'm brave enough to go out and buy shares today, but I think it's pretty high up on my list, and I don't think these results are bad. I guess the 6% drop when you're such an expensive company anyway, that's one of the risks. Nothing that the company can do about it, but if your results are right on point, that you're going to have a bit of a market reaction to that. But no, overall rate the company and think it's robust set of results.
What's the valuation like?
It's 21 times forward earnings. 10-year average 23.
I think I don't want to use the word cheap because that is expensive, but I really like the business. What I really, really like about it is we've looked at a couple of similar businesses in terms of that sort of high-end fashion. I wouldn't say quite as high-end as Louis Vuitton, but if you look at Burberry, if you buy that, you are just buying Burberry, basically. If you look at Ralph Lauren, which we covered a while ago, you are basically just getting Ralph Lauren. Now, Ralph Lauren's not anywhere near as good as Louis Vuitton in terms of the brand. But what I like about Louis Vuitton is you've got this umbrella of fantastic quality brands, which you don't really have with anything else in that industry.
Yeah. And
as well, the shares are back to about where they were about a year ago, but they are down about a third from the high of the year. Yeah. And they were closer to sort of 25, 30 times earnings last time we covered them. I really like the business. It's the cheapest we've seen it, slightly below the 10-year average. I don't know if it's the kind of business where you'll get the chance to get it much cheaper, but really like it. I don't think it's unreasonable at 21 times earnings for a business of that quality.
No. And margins 26.6%.
And the results are still good. 17, dropping from 17 to 14% growth. It's still very, and obviously as well as you're paying off the debt on the Tiffany's acquisition, the earnings will start to go up as well again. But
and what a brand to acquire as well.
Yeah, you sleep at night well with that in the portfolio. So I really, really like it, and it's if we cover it again in 6-12 months, would it be any cheaper?
No. And
is it the kind of business you can get at 15 times earnings? I'm not sure it is.
And we'll come on. Well, no. if it were, it would be the first one I go to. But also, we're going to come on to some other consumer groups later. Very different types, but like Nestle and Pepsi. And when you look at their valuations, without sort of spoiling it, they're either more or similar. And you think, well, they obviously are two other really high quality consumer goods businesses, but which would you rather own? I think I know what I would rather own, and that would be LVMH.
But yeah, I love the brands. I really like the business. I think it's a very strong set of results, and I don't think it's an unreasonable valuation.
Yeah. Okay. Well, tick from us. On to Relx then.
Yep. So this is, I think it's a debut on the show. I'll just cover a bit about it. But Relx, for anyone who doesn't know, Relx is a global provider of information-based analytics and decision tools for professional and business customers. They serve customers in more than 180 countries and have a market cap of £53 billion. They operate in four main industries. The first one is risk, and risk provides customers with information-based analytics and decision tools that combine public and industry-specific content with advanced technology and algorithms to assist them in evaluating and predicting risk and enhancing operational efficiency. We combine data and analytics with deep industry experience to help customers make better decisions and manage risk. We help detect and prevent online fraud and money laundering and deliver insight to insurance companies. We provide digital tools that help industries from aviation to banking improve their operations. Next one is scientific, technical, and medical. Scientific, technical, and medical helps researchers and healthcare professionals advance science and improve health outcomes by combining quality information and data sets with analytical tools to facilitate insights and critical decision-making. We help researchers share knowledge, collaborate, find funding opportunities, and make discoveries. We deliver analysis and insights that help universities, research institutions, governments, and funders achieve their strategic goals. We help doctors and nurses improve the lives of patients, providing insights and tools to find the right clinical answers. The next one is legal. And legal provides legal, regulatory, and business information and analytics that help customers increase their productivity, improve decision-making, and achieve better outcomes. We help lawyers win cases, manage their work more efficiently, serve their clients better, and grow their practices. We assist corporations in better understanding their markets and monitoring relevant news. We partner with leading global associations and customers to help advance the rule of law across the world. LexisNexis Legal and Professional is headquartered in New York and has further principal operations in Dayton, Raleigh, and Toronto in North America, London and Paris in Europe, and cities in other countries in Africa and Asia Pacific. And LexisNexis hosts over 144 billion legal and news documents and records. On average, 1.2 million new legal documents are added daily from over 72,000 sources. Nexis news and business content includes over 39,000 premium sources in 45 languages covering over 180 countries. Includes over 503 million company profiles with a content archive that dates back 45 years. Patent sites includes ratings on the innovative strength of over 144 million patents. So LexisNexis is actually, for tax, we actually do see it quite a bit. So it's one of the professional services that you can pay for. It basically gives you, like, as in tax advisory, it will give you details on like cases and like in detailed sort of reviews of legislation and breakdowns of it. There's a couple of similar services. So at work, we don't actually use LexisNexis, but annoyingly, every now and then you will be looking for something to do with like, I don't know, a specific case or how a very sort of technical part of legislation works. You might struggle to find it on the resource that we pay for at work. And then you have a little look and you can find a LexisNexis link that's hidden behind a paywall that, based on the title, seems to have exactly what you are looking for. So it is a very, very high quality service as well. A bit of a tangent, but the CTA, so the Chartered Taxation Advisor courses that I'm working through at the minute, the course materials are Relx. So it says at the bottom of every sort of page when I'm working through them that it's Relx. Very, very high quality. And as well, when I've got colleagues that have done CTA training and they've done it through LexisNexis, very, very high quality, pretty strong moat because it's so technical, but yeah, really high quality. And then the final segment is exhibitions, and exhibitions combines industry expertise with data and digital tools to help customers connect digitally and face-to-face, learn about markets, source products, and complete transactions. Relx have come out with a 9-month trading statement, and they've said that underlying revenues have grown 8% over the first 9 months of the year. Its smallest business, exhibitions, was the star performer, growing 32%, with event revenues remaining above pre-pandemic levels. Revenue growth in the three analytics businesses, legal, scientific, and risk, were all in mid to high single-digit territory. The initial testing of Relx's AI-powered legal assistant has progressed well. The full-year outlook is unchanged, with growth in revenue and underlying operating profit expected to remain above historical levels. Its digital products account for 84% of group revenue, and the company has a large competitive moat due to its proprietary, hard-to-replicate data and sophisticated analysis that provides valuable customer insights. Over 50% of revenue comes from recurring subscription models, providing stable and predictable cash flows. Future growth is going to be driven by improving data analytics, the use of AI being a key element. In terms of valuation, they are quite expensive at the minute. I suspect that's because of the buzz around AI. They're trading at a PE of 27, basically 28.
Yeah.
But it looks like that's a forward PE of 24, and that compares to a 10-year average of 19.3. Prospective yield over the next 12 months is 2.2%. Probably mixed views on this. I think this is a strong trading statement. I think it's a very, very high quality business. However, I think it's quite expensive. I think if it didn't have stuff to do with AI, it would probably be about 20% cheaper. But I also, although the parts of the business that I see at work, I know are really high quality, some of those segments, I think for me, would probably go in the too hard pile. I know it is a very good business. I think Terry Smith had it at one point. I don't know if he still does. I really like it, but it's probably going in the too hard pile anyway. And if it wasn't, it's probably a bit too pricey. John, what are your views?
Similar. It looks really, really interesting. And I know you'd mentioned in your job in accountancy, you'd seen it sort of practically being used and were quite impressed with it. I know in pharmacy, certainly at the wholesale end, it's used quite a lot. And that's the only sort of knowledge I'd had on it, prior to looking at it now. It is expensive, but I think you mentioned the moat rather, and that it's very high quality. It does seem like something, rather than just having the AI buzz around it, that AI could really change or enhance this type of business. So it may be fair enough for that to be reflected in the price, although of course you don't want to overpay for it. It's one I think it is hard to understand, and it's quite diversified over a number of industries. I think it's one that I would like to dig in more to and look exactly at where all of the sources of revenue come from and those industries in themselves. That certainly would take, I think, quite a lot of time and research, just because of, I suppose, how niche they are and how many sectors that it operates in. So I think I'll do some more digging, but I guess, as you say, is it worth doing that if you think it's, well, one thing, going to be very difficult to understand, but also, so expensive? And I guess that's the question. But
I think it's definitely interesting enough for me that I'd do it again on the show in sort of 6-12 months.
Yeah.
And it might be one where after we've done it 2 or 3 times, we've got a bit of a better understanding of it.
Yeah, no, I would agree. And I think as well on the website, the investor case is made, pretty effectively, and you have got a lot of videos and insights into exactly how they, the sectors that they operate in, and I suppose the moats that they have in those sectors.
Should we continue our theme of high quality businesses?
Yes, let's continue. So we've got probably one of the best of consumer goods companies in the world, which is Nestle. We've compared it with Unilever, Kraft Heinz, and Reckitt on the show lots of times before. They had their third quarter results out last week with reported sales of 68.8 billion Swiss francs in the first 9 months of the year. And that reflected organic growth of 7.8%, with price hikes of 8.4%, offsetting a small decline in volumes. There's a broad-based growth across all geographies and categories, with Purina Pet Care the largest contributor to organic growth. E-commerce sales grew by 12.7%, reaching 16.6% of total group sales. And the group is continuing to tweak its brand portfolio. In the third quarter, it divested in its peanut allergy treatment business and formed a joint venture for frozen pizzas and acquired a Brazilian chocolate company. The group remains on track to deliver full-year organic sales growth of between 6 and 8%, and underlying operating margins of between 17 and 17.5%, underlying earnings per share of between 6 and 10%. In terms of its current valuation, it has a market cap of about 264 billion Swiss francs and trades at just under 20 times forward earnings with a 10-year average of 21.5, and it has a prospective dividend yield of 3%. Again, as we've come to expect, decent results, but perhaps not as good as we've had over the last year or two, with a small decline in volumes. But they are trimming their lower quality brands and their 20% stake in L'Oreal and maintaining those superior margins to what we've seen in recent years from Unilever, Reckitt and Kraft Heinz. I think if I were a shareholder, perhaps a little bit disappointing. I mean, I think when we've seen them grow both the sales and not see any drop off in volumes when they were hiking quite aggressively over, say, the last 18 months, that was really, really impressive. And it's something that Unilever and Reckitt on the whole, I mean, Unilever maybe changed recently, but haven't been able to do. So I think that was great. The brands that it owns, including sort of, well, Nespresso, so dominant in their sectors. I guess what it usually comes down to is, are you willing to pay up for it? But they are a bit cheaper, and on the basis of these results, things are sort of slowing a bit. But I think if you were to buy and hold and just sort of forget about this kind of company over the long term, I think it would deliver very, very good results. So I like it. Slightly underwhelming this time, but I don't think overall it significantly knocks the investment case for it.
I agree. Very, very high quality business. Probably the highest quality consumer goods business that we cover. I think it's just a cut above Unilever, I think, particularly in terms of the results it's been putting up in the last few years. These results are probably the worst set we've seen. I thought they'd be better given how good the Tesco results were. I know they're not exactly the same, but the Tesco results were double digits, so I kind of expected the same. So it is a bit disappointing. But the last few times we've covered it, it's been about 25 times earnings, and it's now just below 20 on a forward basis. So you are getting a bit of a discount. The dividend yield of 3% is not terrible, and it is a very, very high quality business. It's probably not. I'd probably like to see it a little bit cheaper still. I think if we covered it again, I know I always say that, but if we covered it again in sort of 6-12 months and it was at 17, 18 times earnings, I'd probably feel a lot better, but it's a lot closer now. But yeah, fantastic business. Not the best set of results, but equally not terrible. And given the last few years, it's overall they've done very well. But yeah, I really like the business.
Yeah. Okay, moving on. Whitbread, a company that's on the recovery.
It is, yeah. So fits surprisingly well into the quality business theme we've got this week, with the arguable exception of OnTheMarket. Whitbread have come out with their half-year results, and half-year revenues have increased 17% to 1.6 billion. This included a 14% increase in the revenue per available room in the core UK business. Positive momentum has continued in the opening weeks of the second half in both the UK and Germany. Together with cost savings, the revenue performance helped underlying operating profit growth 30% to 445 million. Free cash flow improved from 177 million to 345 million, while net cash at the half-year end totaled 67 million. Strong hotel demand is driving a search for opportunities to grow the room pipeline towards a long-term potential of 125,000 rooms across the UK and Ireland. And for context, they're currently at about, I think it's 91,000 rooms, maybe 30 to 40% growth. And they've seen an increase in capital expenditure guidance for the full year to 500 to 550 million. I don't really have an issue with that, given that they're using it to increase the number of rooms. The interim dividend has been up by 40% to 34.1p, and a further £300 million buyback was announced. So the fact they're in a position to buy back shares as well just shows how well they're doing. Premier Inn is now the UK's largest hotel chain, and the average revenue generated by each room are now more than 40% above pre-pandemic levels, which I found that absolutely staggering, especially when you look at other industries such as airlines, where they're not even at pre-pandemic level. And this, I would say, is a business that was hit just as badly by the pandemic as the airlines. I think this is an absolutely fantastic turnaround. The German business is is going quite well, but it's still a much smaller footprint and it's yet to turn a profit. But about 60% of rooms in Germany are run by private hotels, so they do think there's a big opportunity there for, a big hotelier like Premier Inn to come in and establish a foothold. In terms of the business model, they own over half the hotels rather than leasing them, so that puts them in a very strong position. And for the reinvestment plans of $500,000, that should be fully funded by the cash flows in the business, so they're not having to take on debt to do it. In terms of the valuation, it trades at a forward price to book of 1.5, and that compares to a 10-year average of 2.2. In terms of the earnings, it's at a PE of about 20 now. The prospective yield for the next 12 months is 2.7%, and that compares to a 10-year average of 2%. I think these are an absolutely fantastic set of results. It's a fantastic turnaround since the pandemic, when it almost looked, there were serious questions about how much it would recover at all. It's done really, really well. The German business is going well, but I think based on how well the UK business is doing and how much they think they can grow the rooms and how well they're doing with the current rooms, if Germany takes off, it's a bonus. But if not, it's not a disaster. And I do like businesses like that. My only complaint is, although it's good on the cost side that they own the hotels, I do prefer the IHG model where they're just franchising them. There's much lower risk there. So although this is a business that is performing probably as well as you could possibly expect, I don't think the valuation is outrageous for the figures it's putting up and the potential growth it's got ahead of it. But I'd probably prefer IHG if I did want exposure to this sector. I think it's just a safer play on it. Not really my kind of industry, but fantastic set of results. And I think credit to the management where it's due, because I do just think that 40% average revenue per room above the pandemic it is actually difficult to believe. John, what are your thoughts?
Yeah, I mean, incredible set of results. Management have done an incredible job at turning things around. And I think there were serious questions, particularly when you had Zoom taking off and whether people, I suppose, in middling business would be traveling around as much and sort of using groups like Premier Inn under the Whitbread umbrella. But that's, not been the case. And as you say, 40% above per room for the, above pre-pandemic levels. So absolutely fantastic. And I think there's a good chance that the German business will do well in the longer term. And that sort of, I suppose, value proposition, large number of independents in Germany, it seems ripe for Premier Inn to go in and really capitalize on that. I think the business was always better when it did have Costa, and I know they got a lot of cash from Coca-Cola when they sold that, but probably not one just given the sector that I would go and invest in. But what a job they're doing at it. And yeah, again, valuation rise, not unreasonable given the direction the group's going in.
Well, I remember when we covered it in the pandemic, the occupancy had obviously fallen off a cliff. There was questions about whether it could return at all. And I think at that point, it was trading at about 18 times earnings. And I remember thinking, who's going to pay 8? Now, I don't actually, I mean, if someone had the foresight to see what it would do over the next few years, fair play. But even in like the most optimistic predictions, I would not have predicted this. So in the pandemic, I thought it was quite expensive at the time, but obviously that was wrong. But yeah, fantastic job. Shall we move on to another high quality business? It's very easy to link them together this week.
It is. So PepsiCo, which is obviously owner of the famous cola brand Pepsi, but also has Walkers, Doritos, Quaker Oats, and other, I suppose, snack groups under that umbrella. So Pepsi had their third quarter results out with revenue up 8.8% on an organic basis to $23.5 billion, reflecting rising sales across all regions. And price hikes were the main contributor to that, as beverage volumes remained broadly flat and food volumes declined by 1.5%. Underlying operating profit rose 12.1% to $4 billion, helped by price hikes and cost-cutting measures. Free cash flow improved from $4 billion to $5.2 billion, and net debt has crept up from $33.7 billion to $34.5 billion since the beginning of the calendar year. This financial year, Pepsi expects to return around $7.7 billion worth of cash back to investors through dividends of $6.7 billion and a share buyback of $1 billion. Full-year organic growth guidance has been maintained at 10%, and earnings per share growth guidance has been upgraded by 1 percentage point to 13%, ignoring exchange rates. And the shares were broadly flat on the results. In terms of valuation, Pepsi has a massive market cap, again, like all of the companies this week, of $223 billion, and trades at around 20.5 times forward earnings with a prospective yield of 3.2%. I thought these results pretty good. I mean, incredibly high quality company with those brands, and it does franchise out some of the ones that it owns. We know that with AG Bar and Britvic back in the UK. Guidance pretty decent. It's got an excellent track record, and the really strong brands. I think, again, a bit like Nestle, slightly disappointing in that we saw some of the volumes decline, particularly in the snacks and sort of food business, and only flat in the beverage sales. But saying that, very good margins, and they still did grow revenue by a decent amount. So I can't knock it too much. I think, it's one of those companies you could have in your portfolio, and it's going to do very well over the long term. Probably not shoot the lights out. Shares are never going to be cheap, but are probably more favourable than they have been in the last 10 years. So I think, it would be a reasonable opportunity to take a position in Pepsi, but middling results in this most recent third quarter.
I agree. I think it's a pretty similar story to Nestle. You could probably just copy and paste the comments we said about Nestle. Growth figures very similar. Drop off in valuation very similar. I think it's 15-20%. Cheapest we've probably seen it, PepsiCo. Very, very good business. I don't think I'd want to pay 20 times earnings for it though. If it dropped a bit more, I'd maybe be more interested. But still a decent set of results and a very, very good company. But yeah, not the best set of results we've seen, but that's why we've seen the drop off in the price, I think. But yeah, you can't really knock the quality of the business.
So then, Sam, of the companies this week, and we have quite a lot that we like, which would you choose first, and what would be last of your list?
First would be LVMH. I think it's the highest quality business. It's probably got the best results, apart from Whitbread. And the valuation, I don't think, is outrageous for the quality of the business. Last is really tough. So it would be on the market by default, but there wouldn't really be any point buying it anyway because it's about to be sold. So if I exclude on the market, I'd probably do Whitbread, but actually no, maybe Relx, because Whitbread, the results are fantastic. Relx, I don't feel like I understand it enough that I'd be comfortable. But if you exclude on the market on the basis it's going to be sold, there's not really a loser this week. They are all really good businesses putting up pretty good results. What about you?
Yeah, it's difficult because on the market, it's do you want to buy CoStar? And we haven't actually looked at CoStar. Maybe it should be our US company of the week when they have results out going forward. That's kind of excluded. I think if you were buying the old on the market business, it would be a definite no, but you're just going to be CoStar, aren't you? LVMH, I think, would be my top pick. And again, I don't think there's a loser. Relx, I take your point on sort of understanding it, and I certainly wouldn't be buying shares until I did fully understand the business. So maybe Whitbread, but again, it's not a company that I really dislike or think is doing badly. Maybe a sector that I wouldn't invest in, but yeah, like you say, no loser this week. But then you look at the overall market, and I suppose we've got different geopolitical events and things going on, but it's retreating.
Yeah.
Anyway, I suppose we are looking at what's happened over the last number of months rather than going forward with these things. Thank you again for listening, and we'll see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.